Hello everyone. Welcome to this class. This class is about VC, IPO, and merger acquisition. But for this semester, we're gonna focus on the merger acquisition. Although I will also use like 2 to 3 weeks to talk about VC and IPO because they're all like part of the process. And for this class, we're gonna because I mean some of you haven't returned back to the mainland China. So we're gonna use a combination of recorded class and the live session. And so let me first go through the syllabus. The goal of the subject is to develop the concepts in merger acquisition, venture capital, and IPO. And after learning the class, you will learn the basic skills of merger acquisition, how to value a merger, and what are the incentives of major players in the M&A process. We'll also, from time to time, talk about the empirical findings in the M&A research. So this is the original time, right? So I mean, if we don't do video recording, if we don't do like online teaching, that will be the normal time. But now, because I'm gonna do recorded class, right? So and part of our class will be recorded class. So this time, the class time will be for Q&A. So remember, we're still gonna have the same class time, but it's just that on the class time, it will be like Q&A. Of course, there will be other live sessions. And the class videos will be uploaded before each class. So it will be for you to review like together with the slides. This is the office hour, and of course you can send me email anytime to schedule time to talk. Our teaching assistant is Jialiu, right? And there are 5 live sessions on Zoom, right? So at the Thursday class time, five live session. So the number of session is subject to change. So if there are necessary events or if there are necessary things that we need to talk about, I will schedule more live sessions. That's no problem. So tentatively, we're gonna have these 5 live sessions on Zoom, right? And then meeting information about these live sessions will be provided in advance. Basically, these live sessions will be for example, I will talk about like summarizes the key points of the past 2 weeks maybe. And then we will also have presentations on these live sessions, right? So I will hear about your presentations, for example. So that's why if I feel like we need to hold additional live session, I will tell you in advance. But these 5, they are tentative, right? So because I cannot forecast like how many exactly more sessions will be held, right? So this will be subject to further discussion or further modification. For the assessment, case presentation accounts for 40%. So I mean, I call it a case presentation, but it could be mini project presentation. And final individual report, 20%. And the final project accounts for 40%, right? So, and you will mainly operate in groups. You will mainly work in groups. And here's the textbook. We use mergers, acquisition, corporate structuring. This book by Patrick Gohan, 7th edition, right? You can also get other editions. But if you Google the name of the book, you should be able to find an electronic version. So if you have difficulty getting a copy of the book, you can reach out to me and I will try to see what I can do. And before each class, the lecture notes and the videos will be uploaded online. And I will also send you the list of additional readings, except the lecture notes, of course, right? And 1 week before each class, right? And basically, I'm gonna base my teaching on this textbook. Of course, I will also supplement the teaching by other lecture notes that I wrote, right? So we're gonna cover the following topics. First one, we're gonna talk about introduction. We're gonna have a long introduction. And the introduction, it's about 2 weeks. We will talk about the terminology, talk about the history of the mergers, and the methodology to evaluate the market reaction to merger, etc. And topic 2, it's about merger strategy. And we'll talk about synergies in merger, right? So what are the reasons why we need to do a merger? Topic 3, it's about anti-takeover measures. Topic 4, we're going to talk about takeover tactics. And then topic 5, we're going to talk about LBO and private equity. So LBO is leverage buyout. So these are special types of deals. Topic 6, we're going to talk about valuation. And this part I'm going to supplement by other materials. And topic 7, we're going to talk about venture capital and IPO. Also, I'm going to supplement with my lecture notes elsewhere, right? Topic 8, we're going to talk about corporate restructuring. Next, we're going to talk about corporate governance. And finally, we're going to talk about joint venture and strategic alliances. So it's about 10 topics. Okay, so because the assessment has 3 components, right? The first one is case presentation. The second one is individual report. And the last one is final project. The key thing is that before the semester begins, you need to form a group of 3 persons, because I guess we have about 10 to 15 people, right? So you need to form a group of 3, and there will be 5 case or mini projects during the semester. So it's about like 2 weeks, 1 project, 2 weeks, 1 case. And then for each of them, each group need to analyze the case or like mini project, and then present analysis on the live session that will be held on the Zoom session. And also after you present it, a written report needs to be submitted as well, right? So presentation will be graded based on accuracy and the reflection of the class materials, reflection of the understanding of the class materials. And remember, each of you needs to present, right? And the report needs to be submitted within 3 days of the presentation. And students, you guys should email the scanned copy of the homework to TA or me, right? You can email the report to us. Just about delayed accepted, but no later than 5 days after presentation. And the report should be written in English. And that will be a final individual report. And I will announce the exact requirements on the last week of October. You'll need to write a report for a topic in merger acquisition. But in that case, you don't have to present your report. So you just need to write it and send it to me. And because you have a group, right? And then each group is required to complete a case study on merger acquisition involving a US company as either the target or the acquirer. And I will send you the kind of more details about the structure of this final project later. But to summarize, the basic idea is that you should begin with some background information, like industry background. And then you need to focus on the synergy and evaluation of the target firm and deal and the process of this deal. And then when you kind of prepare the project, prepare this case study, you need to use what you have learned from the class. Right? So that's the idea. And so this is pretty much what you need to do for this class. So after you have read the syllabus, please try to form a group first, form a group of 3, right? If you cannot find a group mate, that's fine. So when the semester begins, TA and I, we will assign you to a group, right? So it's about 3 people. Okay, so this is the syllabus. Okay, now we're gonna start with introduction. And before we start, it's gonna be a long introduction, right? So you can see it's about like 130 pages. So it's a long introduction in the sense of I will try to introduce the process of a merger acquisition. I mean, what's in a merger agreement? What are the process of a merger? And I will also go through the history of merger, right? So what typically are the reasons why there's a merger acquisition? What are the reasons why there are historically there are periods of like high merger acquisition activity, there are periods of low merger acquisition activity. So we're gonna talk about those. We'll also talk about how do you like evaluate the market reactions to merger acquisition. Of course, when we talk about these kind of things, that might involve additional like knowledge, additional understanding, on additional knowledge about other subjects like corporate finance. Right? I'll try to smooth that kind of transition in a sense of I'll just tell you the kind of necessary details you need to know for understanding merger acquisition, right? But for example, when we talk about MA valuation, right, we can spend a half a semester talking about it, right? Starting from NPV valuation, how to value a stock, etc. Right? We can spend a half a semester on it, but that's not possible in this MA classes, right? I will try to condense these prerequisite knowledge into something that's readily available for you to kind of do valuation exercise, for example. So in this introduction, we're gonna talk about three things. We're gonna talk about the recent MA trends, right? So in 2019, right? Of course, we cannot talk about trends in 2020, right? So because of the coronavirus, right, all economic activity seems to be suspended, right? So there's not much trend we can talk about in 2020, right? But we can talk about the trends in 2019, even the trends in the past 5 years, right? So we're gonna focus on the volume of the MA. We're gonna also focus on, how are the merger acquisition? How do the merger acquisitions look like these days, right? What are the kind of motivations for doing merger acquisitions these days? I mean, all through the history, right? So there are different periods of merger acquisition, and in different periods, merger acquisition activity is driven by different economic reasons, and then there have been innovations in terms of deal structure. There's also innovation in terms of tactics, right? And recently, there are also innovations about the business mode to do merger acquisition, right? So these are all innovations that have been happening in the world of MA. Right? And then we're going to talk about a big chunk of the introduction, which is talk about the concept of MA and also the terminology in MA, right? So there are many technical terms of merger acquisition. So this part is a bit dry because there's not much to talk about, right? This is just how investment banks, how companies do MA, right? So that's how it goes. Finally, we're going to talk about MA waves in history. Basically, MA waves means periods of very active or abnormally high MA activity. Right? So we're going to talk about what were the typical features of the historical merger waves, right? History is always repeating itself, right? In the sense of, the factors or like the features that have been, the features that drive the merger acquisition like 20 years ago, they might still be part of the features that drive the current MA wave, right? So in that sense, merger acquisition activity, it's always like they have recurring features. For example, consolidation. For example, technology shock, right? These are the recurring features of MA activity, right? So we're gonna talk about what happened in history, right? And then so you know that what are the fundamental economic reasons. First, we're gonna talk about the MA trend recently, right? So we're gonna first talk about a summary of the 2019 MA activity. Basically, the volume of MA targeting companies based in North America. So we're gonna focus on North American MA because if we talk about a global merger acquisition, that's gonna be a long story. For now, we're gonna just focus on merger acquisition that happen in North America, especially in US, right? Because that's a typical market that we wanna start from, right? Because that has the feature of the most modern way to think about MA. Of course, later we're gonna talk about cross-border merger acquisition, right? Especially the merger acquisition between Chinese company and a US company, right? Of course, that was history now, but there was a time where the cross-border acquisition of Chinese company has been very active, was very active, right? And also the private equity and the venture capital activity was more positive for the region, right? As volume and value increased. Right? We're gonna talk about these PE and VC in detail later when we talk about private equity and VC separately in separate topics. So this is the US deals by volume and value, right? So you can see this is the number of deals, this is the total deal volume. I mean, you can see it's almost similar to like 2018. Right? So there is in the 2018, 2019, there is a slight drop in the number of deals and also the total deal value. There's a slight drop, but that's still basically similar to like previous years. And what we're interested in is sector trends, right? Because merger acquisition has a strong sector feature. The most valuable North America deal of 2019 is the Bristol-Myers Squibb acquisition of the pharmaceutical manufacturer Celgene, right? And then this deal, it's worth 74,000 million, right? So that's a huge deal. And this is in the pharmaceutical industry, right? And what happened in pharmaceutical industry like in recent years, it is still like consolidation. I mean, that has been a recurring feature of pharmaceutical industry for a couple of years, right? And this deal accounts for 5% of total MA value in this North America, right, in the North American region. And when we look at the largest PE and the VC-backed deal, that will be the Blackstone group. Blackstone, it's a big PE group, right? Blackstone bought GLP's US urban infill logistic assets, right? So this is the largest PE and VC-backed deal. Of course, that's a private company deal. And then you can see this is essentially a asset purchase, right? Not a typical like merger acquisition, right? Because when we talk about merger acquisition, that's usually change of control. So change of control meaning that if you buy another company, that company become yours, right? That's the idea. So more sector trends, right? So banking, insurance, financial services, they top the sector rankings by value, and followed closely by computer software, right? So these sectors, they still kind of are very active in terms of MA, right? The reason is that, I mean, we all know what happened in the past 5 or 10 years, right? There is a emergence of fintech, right? And then the emergence of fintech, or also like the emergence of blockchain, the emergence of insurtech. This emergence of technology has gradually changed the outlook of banking and the financial industry. I mean, it has been, I mean, I wouldn't say it's like transformative, but it's definitely changing the way financial industry is operating, right? So of course, computer software has been very, very hot these years as well. Right, so that's why this industry is also very active in terms of MA activity. And business service sector was the most frequently targeted, right? And then computer service was the second, banking, insurance, and financial services was the third. Construction, banking, insurance, and financial services, they were the third and the fourth, right? That's the idea. And so this table provides you the target sector by volume. So target sector means sectors where sectors by the companies that become the target of a merger acquisition. So later we'll talk about how we define the target company and acquired company later. All right. So, but here I mean, in most cases, there will be just a smaller company of the two, right? Because in merger acquisition, there will be just one company buying the other. So the smaller company is what we call a target, right? So in terms of the target, business services is the first one. The second one is computer software. And we will explain why in a little bit when we talk about emerging trends. And this is target sector by value, right? You can take a look as well. Now, we can take a closer look at the deals by industry, right? So the pharma industry, they continue to like buck up and smarten up, right? The buck up means that the pharmaceutical company having consolidating, right? Smarten up means the pharmaceutical company, they have been integrating technology from those biotech startups, right? So, and that can also explain why, right? Business services and computer software, they have been the top target sectors, right? So, I mean, the strong kind of trend in these years is that because of the emergence of technology, right? FinTech, InsurTech, and because of this emergence of technology, many companies in other sectors, for example, banking, for example, pharmaceutical industry, healthcare, they have been buying companies in those high-tech industry, right, in order to build up their competitive edge, right? So that's the reason why the business service and computer software, they have been like target sector in terms, the top target sector in terms of deal volume and deal value, right? And of course, we have this very big deal from between Bristol Myers and Celgene. That's a very big deal, right? And then Takeda acquired Sure, and Sanofi and Novartis. They are all like big pharmaceutical company, and they all acquire company in the 10 billion range, right? So that's what happened in the pharmaceutical industry. And the reason why companies buying again, it's because the merger acquisition, they can bring new technology to the big firms, right? And that also contribute to the concentrated industry structure in this particular industry. Right? At the same time, the big insurance mergers, like between CVS and Aetna and Cigna Express Scripts, right? These are insurance companies. They also begin a work of integration, right? So you can see it's always integration, consolidation that drives the mergers, right? I mean, that have been happening like for many years. Right? Now, when we look at media industry, that's a similar spirit, right? So media and the telecom companies, they also continue to build market power, right? So in 2019, there was 3 big mergers that were finalized or completed, right? So remember, when we say a merger was announced, that's different from a merger was completed, right? Basically, in many cases, public companies, they first announced they're gonna merge, then it's gonna take a year or two for public companies to complete the merger, right? So because there are many restructuring integration process, right, after the merger acquisition. So that's why there's a lack of like 1 or 2 years between the merger announcement and the merger completion. So there are 3 big mergers that were completed, like Sprint and T-Mobile. So Sprint and T-Mobile, they were both big wireless service provider in US. I mean, if you travel to US, you know these are 2 big players. And the second deal was between AT&T and Time Warner, right? So AT&T was the biggest wireless provider in US, right? And Time Warner was the biggest media company, entertainment company, one of the biggest media companies in US, right? We all know Time Warner Brothers, right? Which produces film and pictures. And there was also another deal that was completed in the media industry, right? So the MA between Disney and 21st Century Fox, right? These 2 are also big media companies, right? Who produce the content, right? So that's also a big deal, right? 71 billion. And Disney acquisition in the last few years are kind of trying to strengthen the company's aggressive offerings in streaming video. Yeah? I mean, one kind of trend you might all be aware of is that in recent years, streaming video, it seems to be the future of media. Right? So many big companies, they have been competing in the streaming video area. Right? For example, the merger between AT&T and Time Warner, one of the purpose was also to strengthen, was also to building the competitive edge of AT&T and Time Warner in the streaming video field, right? And Netflix, they were the initial like streaming video company, right? Amazon, right? They were also joining they have been also competing in this area, like app. And in addition, Apple, HBO, Hulu, right? They were all competing in this streaming video area. Right? And then this ecosystem will eventually lead itself to the consolidation too, right? So you can see basically it's like a life cycle, right? Competition goes up, then there's consolidation. And consolidation means there's much acquisition between companies, right? Which lead to more M&A activity. And there are also merger acquisition activity for industrial producers. And in this industry, the typical feature is that there is a breakup of conglomerates, right? Because in the field or in the sector of industrial producers, there have been very big conglomerates, right? Like Dow Chemicals, right? Dow was a very big conglomerate. And also DuPont, right? DuPont was also a very big conglomerate in the industrial production, right? Later, when we talk about the merger waves, we will talk about why and when these big conglomerates formed, right? That was essentially in the first merger wave that happened in like 80, 90s, right? So 80, 90s in these periods. That was the very first merger wave that fueled the kind of growth of these big conglomerates. What we see in these years is that these big conglomerates, they begin to break up, right? Meaning that the divisions, the subsidiaries began to be spin off, begin to be split from these parent companies. And this two-step process involved the merger to consolidate businesses and then followed by the spin-offs that enhance the focus in each business, right? While still maintaining the market power, right? So this is the feature. We're gonna actually, when we talk about spin-off, we're gonna talk about the fundamental rationale of this two-step process. Basically, this story of deconglomeration, right, the breakup of the big conglomerate company, was often two steps forward and one step back, like consolidation, spin-off, consolidation, breakup, right? So that's usually how it works in the industrial producers industry, right? So this one talk about another example, right? So Dana has been done only to bulk up again by buying GE's units, right? For example, I mean, the way it works is that these big companies, they first consolidate by merging each other, right? And then they spin off, right? And then they buy other company again. They buy like other subsidiary of another company again, right? So you can see there's a cycle in terms of MA spin off, MA spin off, right? So this is the industry producers. Now we're gonna talk about the kind of very hot features in these years that drive the merger acquisition. Yeah? The kind of emergent trends in technology that was the driver of M&A activity in recent years. Yeah? And one of the trends in technology is that there have been renewed effort to contain the growth of technology. And why do we need to contain the growth of technology? One of the reasons is that these big tech companies, they become so big that there have been antitrust concerns for these technology companies. right? For example, Google faced antitrust investigation in 50 states, and FTC had suggested it could pursue others, right? So this is one of the reasons why. So there have been like growing concerns about technology company, right? Because those big technology companies, they have been too big. That's why there are antitrust concerns, right? And also FTC was Federal Trade Commission, has been considering injunction against the Facebook, right, to stop it from integrating Instagram, WhatsApp, and Messenger, right? Because you can see the antitrust concern here is obvious, right? For example, when Facebook integrated Instagram, WhatsApp, and Messenger, Facebook will become the monopoly, almost monopoly in the field, in the industry of social media, social network, right? So that's why FTC has been, or like FTC and the Department of Justice, they were the regulatory authority in terms of antitrust, right? So that's why these regulatory authorities they have been thinking about containing the growth, right? Because if these companies they keep on buying those smaller companies, right? At the end of the day, they will have significant monopoly power, right? Another big deal, one large tech deal that closed this year is the deal between IBM and Red Hat, right? That deal was worth 34 billion, and also the deal between Salesforce and Tadbill, which is worth 16 billion. Yes, these are all big technology deals, right? IBM we all know. So Red Hat, it's a business services company. Salesforce, it's a ERP company. So Tableau, we also know these. That's a business service company as well. And also what we see in 2019, right? Perhaps you already know that's the rebordering of technology, right? So I mean, in the past 10 years, we see many Chinese companies that they were trying to buy companies in US, right? Especially high tech company. But in the past year, or maybe this trend is gonna continue for another 10 years. That is, Chinese investment has dropped to 90% in the last 3 years. Right? So, and this investment will be going down maybe in the next 10 years, right? Because of the tension between China and United States, of course, right? So these were like mainly driven by like the tension between these two countries. And now we're gonna talk about the recent MA trends, right? The fundamental story behind the recent MA deals, right? There are four features of that. The first feature is the corporate divestiture and spin-off, right? As well as private equity exits to plus supply, right? So, because if you think about merger acquisition, there is demand side, there's also supply side. The supply side is the divestiture. So what does divestiture mean? Divestiture means the big company split one of the subsidiary and then sell it to another company. This is called divestiture, right? Divestiture. Another name for it is called spin-off, right? A big company that has many subsidiaries sell one of its subsidiary to another company, right? So that's one of the reason for the demand side, right? Another kind of factor in the demand side is that then there are like private equity exits, right? Because what private equity do is that the private equity they will buy a smaller company, or they will buy, for example, sometimes public company, and then take the company in private, right? And then they will sell the public company, sell the big company to another company, right? And to profit from the price differences. So we'll all talk about the private equity deals later, right? But this is the reason we see a kind of increase in the MA supply side. So many companies, they are up for sale. Right? On the demand side, many big public companies, they have growing levels of cash. Right? The kind of most famous example is Apple, right? We all know Apple has a lot of cash in these years, right? So when company has excessive cash, right, they need to find profitable growth opportunity, profitable investment opportunity, right? one of the investment opportunity was to buy other companies. Right? So that's the demand side. The third feature is a very important one. It's called industry convergence. Right? So what does industry convergence mean? Right? Traditionally, we will think they are very distinct in industry. Right? Financial industry is financial industry. Banks are banks. Right? Technology is technology. Right? We never thought about there could be intersection of banking and technology. We also never thought about there could be interaction of transportation and technology, right? But in recent years, we do see those combinations, right? For example, um, I remember in recent years, like Morgan Stanley, JP Morgan, these many investment banks, they joined together to build a healthcare company. Right? So that's one of the combination. And also like Uber, the rise of Uber, Lyft, right? These kind of ride-sharing companies, they have combined the idea of transportation industry and technology industry, right? These are all unprecedented innovation that kind of convert traditional industry or combine traditional industry sectors, right? I mean, a traditional high-tech company, right, might be like doing a traditional high-tech company might involve other businesses in these years, right? For example, Amazon now has entered into the retail industry, right? For example, Amazon was trying to buy like Whole Food, that's a retail store, right? So, but traditionally we think that Amazon is a high-tech company. We never thought that Amazon is a retail company, right? So now you can see there is increasing convergence between industry. Right? That's one of the trends. And when industry converge, one of the consequences is that there are more unconventional merger acquisitions, right? So a bank buys another high-tech company. A high-tech company buys another healthcare company, right? So these kind of deals. Finally, resilience supports M&A activity, right? So we'll talk about these things. So supply side, we already talked about, right? So the device trades by corporation and PE, they seem to cash in on high valuations and sell assets that are at risk of underperforming before the next recession. Right? So why this? Right? Because you have been hearing about this upcoming recession kind of theory for a long time in the past, like maybe 2 or 3 years, right? And because there's one kind of idea which is like 10 years. It's about like 10 years after the previous financial crisis that happened in 2008, right? So maybe it's time that the next financial crisis will be up, right? So now we all know that next recession is coming, but we just don't know when, right? Now it seems the next recession is gonna go up because of the coronavirus, right? That's already a very strong signal that recession is coming. But before 2020, before the coronavirus crisis, we have been just expecting that there will be another financial crisis going up, right? So that's why we all know that next recession is going up, but we just don't know when, right? So that's why many corporations and the PEs, they will try to cash in, right? They will try to sell the assets, sell their subsidiaries before the recession comes up, right? Because we know when the next recession comes up, stock market is going to go down, right? So that's why we want to sell everything. The companies want to sell everything before stock market goes down, right? That's the idea. And some of the selling was also part of the reason, was also in response to activist demands, right? So this we will talk about when we talk about hedge fund activists, right? So hedge fund activists, they have been very active in kind of pushing for M&A activities in the recent years, right? So that has been a growing participant in M&A works, right? We will talk about these things later. And there's also another factor that drive the supply side, which is the need to address antitrust concerns, right? Because we talk about that there was an increasing concern increasing antitrust concern in the high tech industry, right? Google becomes too big, Facebook becomes too big, right? These were all antitrust concerns, right? So these growing antitrust concerns has led to more divestiture, more spin-offs of big companies, right? Because spin-off or divestiture, they have been, I mean, they are sometimes the remedies for they were sometimes the remedies for merger, right? The reason is that when the two public companies they were planning to merge, right? They need to get approval from FTC and the Department of Justice. The reason is the FTC and the Department of Justice they might be worried that the combination of the two public companies might cause the industry concentration to be very large, right? They were concerned that the combination will cause monopoly power, so that consumers might suffer from the merger. Right? So that's why regulatory authority like FTC and Department of Justice, they have to approve the merger first, right? And then one of the things they sometimes ask these two merging companies to do is that they need to divest, they need to spin off, they need to divest some of their subsidiaries to reduce this antitrust concern, to reduce the anti-competitive consequence that was brought up by the merger. Right? For example, they need to sell one of the subsidiaries to other company. Right? That's the idea. For this part, we will talk about in greater detail later. Right here, I'm just give you the trends. And also the volume, the value of the PE exits, private equity exits, they are slightly off their peaks of 2017, right? But they are still at moderate to high levels. So meaning that private equity, they are still selling off their stakes in companies, right? They are still selling companies, right? So this becomes the kind of catalyst for the increasing level of supply in these years. On the demand side, we already talked about, right? So that's because in recent years, companies have high levels of cash holdings. For example, in 2018, among the SP Global 1200, the cash holding totaled 2.4 trillion, right? So that's 21% above the level in 2013, right? So you can see companies' cash holdings globally have reached its very high level. Right? I mean, of course, we don't know after 2020, right? Because 2020 has changed many things, right? So maybe after 2020, the cash holdings of these companies will go back to like the levels before the financial crisis, the levels in like 2013, for example, right? So that's one of the conjecture, but we don't know after. I mean, we don't know what will happen after 2020. Right? And over the medium term, some companies will choose to forego M&A activity and instead hold on to their cash in anticipation of economic downturn. I mean, we already have the economic downturn, right, in 2020. Right? So you can see on the demand side, the demand is not very strong, right? Because people or companies, they are holding cash in anticipation of the recession, right? So that's why the demand side is not very strong. That also explains why the M&A activity in 2019 is not, it's not very high, it's not very low, like in the median levels, right? I mean, if the supply is high, the demand is high, then we will see more deals happening, right? And other factors also play a role in the merger acquisition activity in 2019, right? For example, hedge fund activist intervention, right? We will talk about these things later and how like hedge fund activists affect our deal, right? Also, the interest rate environment is also favorable for deal making. Why? Because now we are in a low interest environment, right? I mean, the real interest rate is almost negative now, right? So that's favorable for deal making, right? Because sometimes actually most cases, when company wants to buy another company, they will borrow money from the bank in order to finance the deal, right? So then the low interest rate is good for their borrowing. Right? So that's the favorable macro environment, right? So, I mean, historically, that's also the case, right? When the economic environment is low interest environment, that's almost always the the big contributor to the kind of booming to the MA wave, right? So low interest environment, it's always good for MA activity. And also VC investment, right? In terms of VC investment, the number of VC investment by corporate investors, they have doubled since 2013. And increasingly, the objective of the deals is not to take control of the company, but rather to gain access to specific technology or talents or establish partnerships. Right, so this has something to do with the industry convergence trend that I've been talking about. Right? For example, when a health company wants to obtain the technology, the new technology in the high-tech industry, right? They don't have to buy the high-tech company, which is more costly, right? They can just invest in a high-tech startup, right? In order to have access to the technology the startup company has, right? Another example is that when a pharmaceutical company, they want to build technology partnerships with a high-tech company. They don't have to buy the company, right? They can have venture capital investment in this biotech startup company, right? This is typically called corporate venture capital, right? Because it's venture capital investment by corporate investors, right? And the usual purpose of VC investment is to get access to the technology and help the biotech company, help the technology startup to innovate, to build new innovation, right? So these are typical the purpose of VC investments. And there are two related developments that contributing to this shifting emphasis, right? So one of the development is that the increasing prevalence of tech-enabled business model. All right, so this development is blurring the boundaries between industry, right? So like I said, for example, the healthcare industry and high-tech industry, right? The retail and technology industry, right? And also the banking, the financial services industry and technology industry, right? These are all convergent. The boundary of this industry, they're all convergent. And they lead to convergence of previously very different business sectors, right? And one of, so some of the example is that, for example, the difference between mobility companies and technology companies has blurred, right? Like Uber, Lyft, right? So these are one of the company, one of the example. Another example that traditional banks and insurance companies have faced increasing competition from fintech and insurtech companies, right? And also from digital payment providers, right? In China, this has already become an issue, right? The traditional commercial banks, they are facing greater competition from WeChat, from Alipay, right? Because these are newly arising mobile payment platforms, right? This creates competition for these commercial banks, right? Because more and more people, they are conducting their transaction, they are conducting their payment on WeChat and Alipay, right? For example. And also industry convergence is also occurring between telecommunication and media industry, right? For example, the merger between AT&T and Time Warner. So that's why we see lots of cross-industry partnerships, right? Not necessarily MA, but more cross-industry partnerships. For example, joint ventures and alliances, corporate venture investment, right? This we already said, right? So here are some examples, right? So you can take a look. I'm not gonna say this. And also resilience supports M activity, right? So the idea is that there have been many changes in the global political environment, right? So for example, Brexit, trade wars, and slowdown of China's economy, right? And also foreign international alliances, right? But these kind of things, they don't they don't prevent M activity from booming. So that's the idea. Because deal makers now, they focus more on the fundamentals of the macroeconomic environment, right? Rather than just the latest headlines, right? That's the idea. Okay, now we're gonna take a break and we're gonna move on to talk about the terminology in merger acquisition. Okay, now we're gonna talk about terminology in merger acquisition. Right? So first of all, what is a merger? Or what is a consolidation? Right? So a merger typically differs from consolidation. Right? So a consolidation is a business combination where two or more companies join to form an entirely new company. Right? And then all of the combining companies that dissolved and only the new entity continues to operate. All right, so, but merger is different, right? So for example, if two companies merge, what happens is that if you have acquired a target, typically the acquired survives and the target will be delisted, right? So that's a big kind of difference. So then what is the typical process of a merger? So Mohair in 2007, right? So this is one of the references you can read, right? So this company provides a nice summary of the process of a merger. So this is they have argued that there are two processes in the merger acquisition process. One is the private takeover process, right? So in this process, the mergers, they are not public. So typically in the private takeover process, they are, so two companies, they will be negotiating, right? Or maybe, and that process might also involve other companies, right? And then after the final bidder and the target, they have agreed on the merger terms, then they will jointly announce the takeover, announce the merger. After the public announcement, we have the public takeover process, right? In the private process, the process will be started by private initiation. So it's called private initiation because in many cases it's not publicly announced. Right? And then there will be confidentiality agreement, standstill agreements being signed. There will be bidding negotiation. For example, 5 companies compete for one company, right? Each of them will submit a bid, right? So these are all private. And there's also negotiation, right? Negotiation basically on the price and terms of the deal. And then finally, the final winning bidder and also the target, they will negotiate for a takeover agreement, right? There's also voting agreements, termination provisions, right? Which says if the deal fall apart, right? How much will the acquirer pay the target? How much will target pay the acquirer, right? Termination clauses. And then there will be, after they finalize the merger agreement, the merger will be publicly announced, right? And there could be public bidding going on after the public announcement, meaning that company A and B, they announced the deal, right? But there is a third party who's not satisfied with the deal, right? They will try to join the force and make public bids, right? So maybe the acquirer is paying the target, let's say $25 per share, $25 per share, right? But maybe there's another bidder who thinks that the target is worth more. In that case, they will join the force and say, we want to pay $30 per share, right? That's the idea. And then there will be more negotiation, right? And then after the deal was announced, there will be regulatory approval, right? So regulatory approval means the FTC and Department of Justice, they will try to review the deal details, right? And then try to see whether they want to approve the deal. Basically, they want to make sure that the combination of these two companies do not increase the industry concentration by a lot, right? And then finally, there will be shareholder voting, right? The merger also has to be approved by the shareholders of acquirers at least, right? Sometimes the deal has to be approved by both shareholders of the target company and acquired company, right? And then finally, the MA is completed, right? Takeover will be completed. Right? So let's look at one example. So you can look at the other example on your own, but let's look at one example first. So let me copy this and open it from here. So this is the merger filings of the deal between AT&T and Time Warner. Usually what happens is that after two companies announce the merger, they need to file with SEC this document. And this document will document every single detail of this merger, the price, terms, and the background of the transaction. Right? So let's look at the background of the transaction. So then this filing is called Definitive Merger Agreement 14A, right? But so basically this document documents every single detail of this transaction. Now you can see in this section called the background of the transaction, you will find the history of this transaction. So basically, what are the events that lead to the final announcement of the deal, right? So now you can see this is the deal between AT&T Time Warner, right? And basically, first, the Time Warner board of management regularly consider strategic options, right? And then these are all the historical events, right? So this is what happens to Time Warner in 2008, right? They spin off Time Warner Cable and also AOL and also Time Incorporation. And then on August 25, 2016, right? Jeffrey Wilson, chairman of the AT&T, chairman of the Time Warner, and then also the CEO of AT&T, they met at the offices, right? And then they're gonna discuss, and during the meeting, right? During this first meeting, both senior managers, senior members of AT&T and Time Warner, they were trying to explore the possibility of a potential combination of Time Warner and AT&T. Yeah? So this was the first time the deal was initiated. Right? That's why it's called private initiation, because at that time no investors, they know the first meeting of the senior member of these two companies, right? And that's why it's called private initiation, because it's before the public announcement, right? So then after that, you can see there are many. Then after they started discuss, right, they will try to talk about the prices, talk about the reasons why they merge, and then they're gonna do due diligence, right? Where each company goes to the other company's headquarters to know the insider details, to know more about the company's financial information, technology details, etc. Right? And then you can see every time such negotiation between the senior members of the companies happen, the board of directors needs to be informed, right? So then you can see these are all the discussion details, right? And then finally, this company will agree on the price terms, and the board of directors, they will approve the merger. Huh? So, and then following the meeting, they execute a merger agreement in the evening of October 22nd, 2016. Both companies, they issue a joint press release announcing the transaction and the execution of the merger agreement. Right? So this is typically the process of this merger, of a public firm merger. And all these details need to be disclosed, right? Need to be disclosed in the SEC filings, right? So you can take another look at this filing, right? The documents the merger process, right? Now back to our prior discussion about merger consolidation. What are the differences, right? I mean, even though such kind of differences are disappearing these years, right? Typically, if we are talking about a merger, that's A plus B equals A, right? So just like I said, if company A acquires company B, company A is the surviving company, and then company B is merging to that company A. So what does merging to mean? That means company B is delisted from the stock exchange, and company A is the surviving company. And if we are talking about consolidation company A and B, they merge together and they both disappear, right? Company C is the an entirely new company, right, on the stock exchange. So that's the difference. Now, in merger acquisition, we need to, a very important part, which we'll touch on later in later topics, is how to value this transaction, right? And when we talk about value of the company, we typically are referring to enterprise value, right? And what is enterprise value? It's the base equity price plus the value of the debt and the preferred stock less as cash. That's the enterprise value we're talking about. Base equity price, so what is base equity price, right? So that's the total price less the value of the debt, right? And so this is when the value that we talk about. Of course, I'm gonna teach you how to value a company later when we talk about valuation. But this is the value that we talk about. And in merger acquisition, we're always talking about acquiring the target, right? What are the acquire? What are the target, right? So here we define the buyer as the company with the larger market cap, or the company that is issuing shares to exchange for the other company shares in a stock for stock transaction, right? Typically, I mean, these are different transaction types we're going to touch on later, but typically there are stock for stock transactions. There are also cash stock transaction, which means acquire uses some cash, uses some stock to buy the company, right? So these are all different types of transaction. There's also transaction where all uses cash to buy the target, right? So when we say this company is a buyer, that's the bigger company, or the company that is issuing shares to exchange for the other company shares in a stock for stock transaction. Now we're going to talk about different types of merger, right? So basically we have three types of merger. One is called horizontal merger, right? So horizontal merger occurs when two competitors combine. For example, Exxon and Mobil merger acquisition that happened in the 80s, right? So that's two oil companies, right? So that's what they're competitors. And also the merger acquisition between Pfizer and Wells, right? They are all pharmaceutical companies. And typically, horizontal merger, they usually create antitrust concerns, meaning that regulatory authority, they might be worried that the combination of two competitors might increase the industry competition or make the industry very concentrated, right? The second type of merger is called vertical merger. That's when there are combinations of companies that have a buyer-seller relationship. For example, Italian manufacturer Luxottica acquired eyeglass retailers, right? So retailer, the supplier of the retailer is manufacturer, right? So that's a supplier acquires a customer. That's the idea. And of course, there are many cases where the customer acquires the supplier, right? So when we talk about merger strategy, we'll focus on these details more specifically, right? Another type of deal is called conglomerate merger, right? So this occurs when the companies are not competitors and do not have a buyer-seller relationship, right? Basically, they don't operate in the same industry, and at the same time, they don't have an upstream, downstream relationship, right? For example, the formation of General Electric, right? We all know that General Electric is a very big conglomerate, right? Because they have many irrelevant industry, right? They have presence in many irrelevant industry. For example, electric, for example, infrastructure, for example, manufacturing, for example, pharmaceutical even, right? For example, high tech, right? So these are all irrelevant industry, they are present, right? And also Google, right? So Google has Android, YouTube, Waze, right? They are all different industry, right? And also Facebook, right? Facebook acquired Instagram, WhatsApp, Oculus, right? So these are, I mean, they are somewhat relevant, but they are still very different areas, right? Instagram, WhatsApp, Oculus, right? Right? So these are all different different areas, right? And also Amazon acquires Zappos, Kiva System, Twitch, right? They're all different industry, right? So Twitch is in the gaming industry, Zappos is in the online retailer, right? Amazon recently also bought Whole Food, right? That's a food retailer store, right? So These are different types of merger. And now we're going to talk about merger consideration, right? So this I already talked about, right? So you can have all cash deal, you can have all stock deal, right? All security deal, or a combination of cash and a security deal. So when I say all security deal, this is typically also called stock for stock transaction, right? If a bidder offers the stock in exchange for the target shares, this offer may provide for either a fixed or floating exchange ratio. I mean, typically that means maybe, for example, exchange ratio is like 2, right? So that means I can use 1 share to exchange for 2 shares of your stock, right? So that is exchange ratio, right? And this exchange ratio may be fixed or floating, right? Because so why would the company want the exchange ratio floating? Because the stock prices of 2 companies, they are changing over time, right? If I use a fixed ratio, then when a stock prices changes, that might favor acquire, that might favor target. So there's uncertainty, right, going on if we use a fixed ratio, right? So when the exchange ratio is floating, the bidder offers the dollar value of the shares as opposed to a specific number of shares, right? So let's say I use 1 million, right? But we don't know but we don't know we don't agree on the specific number of shares, because from the time deal is announced till the time deal is completed, the stock price is changing every day, right? That's why the number of shares might be changing, right? So that's why we only agree on the value of the shares, but we don't agree on the number of shares, right? And then this offer provides for maximum and minimum number of shares within the floating value agreement, right? So now you can see when the exchange ratio is floating, that actually prevents risk for both target and acquire, right? I mean, as a target, you don't want acquire stock prices to be going going down, right? Because if the acquire stock price is going down, I mean, this means the acquirer has to issue more shares to buy your company. But that essentially signals that acquirer is not doing well, right? After the deal is announced, till the deal is completed. We will talk about this risk later when we talk about this exchange ratio. Now, one example is from the merger agreement between AT&T and Time Warner, right? So now you can see that's a floating exchange ratio. And then you can see why they need to have a floating exchange ratio, right? So the exchange ratio depends on the average of the volume weighted averages of the trading price, right? Of AT&T stock, right? And on each of the 15 consecutive NYSE trading days, ending on or including the trading day, right? And that is 3 trading days prior to the closing of the transaction, right? Or completion of the transaction. So if the average stock price is between this area, the exchange ratio will be this one, right? This is the exchange ratio, right? 53.75 divided by the average stock price. If the average stock price is greater than this number, now the exchange ratio will be 1.3, right? If the average stock price is less than this lower bound, the exchange ratio will be 1.437, right? Now you can see if the average stock price is smaller, that means the acquirer is not doing well, the exchange ratio got to be higher, of course, right? So acquirer have to have more shares to buy the target company, right? And now there is differences in terms of stock transaction and cash deals, right? Both, I mean, they have both pros and cons, right? So both the stock transaction and cash transaction, they have pros and cons. Stock transaction, they might offer the seller certain tax benefits that cash transaction do not provide, right? So for example, security transaction, they require the parties to agree on not only the value of the security purchased, but also the value of those that are used for payment, right? So this creates an uncertainty, and also may give cash an advantage of security transaction from the seller's point of view. right? Because if you do cash transaction, that typically do not need approval of shareholder. But if you do stock transaction, even if that involve a small fraction of the stocks, that will need the approval on both the value of the security, but also the value of those that are used for payment. And the other advantage is that stock transaction might offer the tax benefits, right? Because if you do cash transaction, the shareholder need to pay tax, right? But if you do the shareholders that receive the cash need to pay tax. But if you do stock transactions, shareholders if they receive stocks, they don't have to pay tax. Right? So that's the idea. But of course, the downside is that all cash deals, they are associated with large debt burdens, right? If you do not have sufficient cash, you have to borrow from banks in order to finance the deal, right? And then this will create debt burdens. And merger agreements, they can have fixed compensation or they can allow for variable payments to the target, right? And some payments, they may include the earnouts where part of the payments is based on the performance of the target, right? So this is the flexible part, the variable payment part of the merger acquisition, of the merger consideration. Another possible feature of a merger consideration is called CVR, the contingent value rights, right? So they will provide some future value based on the occurrence of some events, right? Such as the sales of the target, right? So let's look at one example. In May 2015, the shareholders of this company, Safeway, they received CVRs, right? As a result of this merger, right? So of the merger between Safeway and Albertson Company. And what is the event that triggers the CVR? Right? It is the sale of the property development center of the Safeway real estate. Right? And the sale of this property development CVR, they are associated with this CVR, right? And then the shareholders of the target, they have been promised the CVRs on that deal. Right? And then the first distribution of this CVR is occurred in May 2017, which occurred like 2 years after the merger announcement. And then nearly a year later, there's another CVR issuing to the target shareholder. Right? That's typically related to the sales of the target assets. Now, merger acquisition is a very substantial corporate event. And also, this is an event where there are many merger professionals involved in the process. And we're going to focus on two major players. Of course, the acquired target management, they are the big players, right? But there are also professionals that are involved in this process, right? For example, investment bankers, right? Investment bankers play a very, very significant role in merger acquisition. Right? And then what they do is that they provide a variety of services, right? Including selecting the appropriate target, valuing the target company, right? So investment banks, they will have a special team in terms of valuation of the target. They may also provide advice on strategy. They may also provide or arrange the financing to complete the transaction. Right? And the other major player here is the legal advisor, right, which provides legal services. In both private and public merger acquisition, legal M&A advisors, they will perform a legal due diligence process, right? Basically, they help design the merger agreement and also different provisions in order to reduce the risk of merger acquisition, right? For example, after the merger acquisition, something happens so that maybe there's a hidden liability, hidden fraud in the target assets that are acquired did not find out in the pre-merger due diligence, right? In that case, acquired might want to protect the company, right? May want to protect themselves. That's why the legal advisor may be retained to design such termination clauses, right? To kind of prevent acquired from suffering losses when after the deal is announced, they find out some problems with the target, right? Which might decrease the valuation of target. Right? And the legal advisor was very important in hostile takeover. Right? Later, when we talk about hostile takeover, we'll talk about the typical things the company will do in hostile takeover. They will try to install many defenses in hostile takeover. And then the design of these defenses has to go through lawyers, right? Because these defenses, in many cases, touch upon the corporate laws, right? The legal MA advisor or the legal counselor, they need to know, they need to kind of design the defenses so that those defenses do not violate the business combination laws, right? Do not kind of hurt the interest of the company, right? That's the idea. And this table provides the top financial advisor in 2016, right? Like Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan Chase, right? These are all the big players in this game. And investment bankers for buy side and sell side, they are responsible for different kind of things, of course, right? For the buy side financial advisor, they assist their clients in developing a proposal and contemplates a deal structure. They may also handle the initial communication with the seller or the representatives, right? And then in addition, they conduct due diligence and evaluation, right? And these investment bankers, the buy side investment banker, they might also do some of the due diligence in order to, in advance, if they happen to bring the deal to the buyer, right? For example, they might do the due diligence themselves in advance, right? And then they contact the buyer, say, we think that this target is valuable to pursue, right? And then present this deal to the buyer, so that buyer might be interested in buying this target, right? Of course, these investment bankers, they earn a commission, right? Typically from 10% to 20% from providing those services, right? And the sales side investment bankers, they do different kind of things, right? So on the sales side, these bankers, they consult with the client, and also they help develop an acquisition memorandum that might be distributed to the qualified potential buyers, right? So in the memorandum, they will provide, for example, the financial condition of a target, the technology that the target currently has, right? And also the banker screens or selects potential buyers, and they will also facilitate the negotiation and the bidding process, right? Of those buyers who are truly interested and have the capability of completing the deal. Right? This table provides the legal advisor table, right? The top legal advisor in this industry. Other professional in the merger includes, for example, accountants and valuation experts. So this is the merger professionals. Now, another party that might be involved in the merger acquisition activity is called arbitrager. Right? Basically, what is the idea of arbitrage here? The idea of arbitrage is that the buying of an asset in one market and selling in to another, right? And so what do arbitragers do in merger acquisition, right? Basically, they look for price discrepancy between different markets for the same assets and seek to sell in the high-priced market. This is what arbitragers do, right? So in MA, one of the kind of arbitrage strategy often pursued by hedge funds is MA arbitrage, right? And what they do is that they purchase stocks of a company that may be taken over, right? And then they can profit from the stock market price appreciation if the company is acquired, right? Because typically in merger acquisition, what happens is the target receive a takeover premium, right? Which will cause the target company's stock prices to increase after the merger announcement. And the hedge fund activists, they can profit from that, right? Of course, they also bear the risk when market turns down and economy slows, these merger acquisition deals will be canceled, right? So this is the risk that they bear. Now, this is what risk arbitrageurs do, right? So basically what they do is that they buy the stakes of a company that they think that will be taken over in a year, right? And then what they do is that they buy in the stakes, right? Let's say 5%, right? And then after the merger acquisition is announced afterwards, they profit from the price in appreciation, right? Right. And then in recent years, in the recent like 5 to 4 years, activists of hedge funds they also facilitate the sale of the target to other investors, right? By pushing the target management to be sold, right? So this is what they do, right? When they try to, because they have stakes in the target company, right? They are the shareholders of the target company. They have the rights to push the management to be sold to another company, right? In that case, they reduce the risk that the target might not be taken over, right? So this is the tactic that we're gonna talk about in chapter 7, right? When we talk about takeover tactics. Now we're gonna talk about the special types of merger acquisition, right? One of the special type of merger acquisition is called LBO, right? Leverage buyout. And also this is related to private equity market, right? So in a leverage buyout, a buyer uses the debt to finance the acquisition of a company, right? And then a related concept is called going private transaction, right? Basically, this is when the public company is bought by a small group or a single buyer, and the company is taken private, meaning the company shares are no longer traded in security markets, right? And most of the LBOs, they are buyouts of small and medium-sized company or divisions of large company, right? And typically, they are private equity firms, right? Oh, sorry, the buyers, they are private equity buyers, and then they typically buy small and medium-sized company, right? A special case here is called management buyout, right? In a management buyout, the buyer is the manager by definition, right? And historically, the leverage buyout businesses they decline after the forced merger, right? Forced merger was like in the 1980s, right? But the leverage buyout rebounded in the fifth merger and then reached the new highs in the 2000s, right? So this is the pattern. So what is the special thing about leverage buyout? The special thing about leverage buyout is that leverage buyout they typically use a significant amount of debt, right? That will significantly increase the leverage of the company, right? And that kind of significant use of debt is together also with equity investment, right? This equity investment comes from investment pools created by private equity firms, right? Like they attract equity investment from institutional shareholders, right? Those kind of things. And the private equity businesses grow significantly between 2000 and 2007 and slowed in the financial crisis, right? The idea is that you can see why do those leverage buyouts boom and why do these things decline, right? That is because a low interest environment is very, very good for private equity to pursue leverage buyouts, right? Because they need to rely on the significant amount of debt, right? So when the interest rate is low, borrowing is very cheap, right? So that's why this is good for private equity firms that pursue leverage buyout transactions. And later in this class, we will talk about corporate restructuring. So they are not typically change of control transaction like merger acquisition, but they are still restructuring activity of a firm. Right? So this restructuring activity usually refers to asset sell-off, such as divestiture, right? Such as you sell one of the subsidiary to another company, right? And the reason why you sell a company might come from poor performance, right? Financial difficulty or changing the strategic orientation of a company, right? And then in the recent years, the divestiture, this activity is usually driven by the demand from hedge fund activists, right? Hedge fund activists might think that one of the subsidiary is being operated with low efficiency, right? So that's why they might push you to spin your subsidiary off, to sell the subsidiary to another company, right? And when the company feels that one of the subsidiary is inefficiently operated, they might try to refocus on the core business and sell the subsidiary, right? And this type of activity increased after the end of the third merger wave, right? Because the third merger wave involved building up many large conglomerates, right? Now, if you form a conglomerate that consists of many irrelevant businesses, right, in many different industries, one of the problems, obviously, is that irrelevant businesses, if they're run together, that might cause inefficiency, right? So that's why divestiture becomes more popular, right? They might sell the company they might sell the company that they originally bought, right? That's the idea. And again, divestiture is one of the remedy for mergers, right? Because if, for example, in this merger between American Airlines and US Airway, which is a very typical horizontal merger, right? Because they are both airline companies. The Antitrust Authority, FTC, and the Department of Justice required American Airlines to sell some of the subsidiary, some of the facilities, right, of American Airlines to other low-cost airlines, right, to reduce the anti-competitive concerns caused by the combination of these two competitors, right? That's one of the things that often happens after the horizontal merger, right, gets approved, of course, right? Now we're going to talk about the merger negotiation, right? So merger negotiation, like we previously illustrated, typically happen before the public announcement of a deal, right? So for buyer-initiated takeovers, the process usually begins when the management of one company contacts the target company, right? Often through the investment bankers. So this is the buyer-initiated takeovers. For seller-initiated deals, the seller may hire an investment banker, right? And the investment banker will contact prospective bidders on behalf of the seller, right? So of course, there are also merger acquisition where both companies they initiate a takeover, right? So like we just talked about, right? In this AT&T and Time Warner deal, what's the beginning of the deal? When is the beginning of the deal? The beginning of the deal is when on August 25th, the CEO of the Time Warner met the CEO of AT&T, and they both discussed the possibility of business combination between AT&T and Time Warner, right? So in that case, this is a deal where both acquire and target, they initiate a deal, right? There's also a type of deal which is called the third party initiated deal. So which is the final bidder and acquirer. So the final acquirer and target, they don't initiate a deal, right? It's the company C that approached the company, it's the company C that approached the target first. And then the final acquirer, which is company B, for example, right? Discuss with company A later and finalize the deal, right? For example, the target firm is company A, the final acquirer is company B. And initially, company C approached the company A and then discussed the deal, right? But then later, after like due diligence, for example, company A and C, they don't find they are fit for merger acquisition. But rather than that, company B approached the company A, right? So in that case, this is a third party initiated deal, right? Not by A, not by B, right? And in this process, if the potential bidders, they sign a confidential agreement and agree not to make us an unsolicited bid. So unsolicited means that the acquirer only or the bidder or the acquirer only submits a bid when requested by the target, right? So only when they agree on those terms, they might receive non-public information, right? So because the target is afraid that the bidder might disclose proprietary information to other competitors, right? Which might costly for the target, right? And another thing is the target might be afraid that the acquirer makes an unsolicited bid, right? Then this becomes a hostile takeover. Right? So we will explain what is a hostile takeover in a bit. And in this process, in this merger negotiation process, the seller and the investment banker might also conduct an auction, right? And they choose to negotiate with just one bidder to reach an agreeable price, right? For example, initially the seller targets 5 bidders, right? And then these 5 bidders, the 5 companies, they participate in this auction, right? And then each of them submits a price, right? And then after the bidding process, only one bidder wins. Wins mean that they pay the highest price, right? And then the target finally will negotiate with just one, this one winning bidder coming out of the bidding process, and then reach a reasonable price, right? And in this merger negotiation process, which typically will take rounds of negotiation, typically causes like several months, right? The management and of both the buyer and the seller, they will keep the board of directors informed on the progress of the negotiation, right? What happens is that there are rounds of negotiation between the target management and the acquire management, right? Each round, acquire management will submit a bid, right? This bid will typically say, how much would I pay you, right? And then this offer might also contain other terms, right? For example, I only pay you $68 per share when the target agrees that some of the assets might be sold after the merger. When the target agrees that certain personnel after the merger of the target company will be fired, right? So then the the target management will discuss with the board of directors on the offers, right? On the offer details, right? Proposed by the acquirer, right? And then they will respond back and get back to the acquirer with the opinions of the board of directors of the target, right? And then they will go back and forth in this process, right? So I will skip the example because they're trying to illustrate the merger process, right? Which I already talked about. And in terms of the merger negotiation, since we talk about the board of directors here, right? Directors, they are required to perform some duties in merger acquisition, right? And then this is required by the corporate law, right? Typically, it's in the Delaware law, right? So why we talk about Delaware law in specific? Because Delaware is the state where most of the public companies incorporate in US, right? That's why Delaware law is the standard, it's the golden standard of corporate law. The directors under Delaware law, they have the duty of the loyalty, right? They also have to demonstrate the care for the interest of shareholder. They also need to carry out duties in a manner that's in the best interest of the incorporation, right? Basically, that basically means directors have to maximize shareholder value. They also need to pay attention to the progress of the company, to the details of the company, to the offers that's coming from other third parties, right? If they want to buy the company, right? They need to serve the best interest of the shareholders, right? That's what the main duties of directors have to be under Delaware law. So in merger acquisition, typically directors must be informed of details in the negotiation process, right? They also need to pay attention to the negotiation details, right? That is reported by the manager. So this is the duty. So let's take a short break and I will talk about the standard. Okay, so now let's talk about the Unicode standard. All right, so this is Unicode standard. So why it's called Unicode standard? Because it's coming from one of the acquisition between Unicode Unico and Massa Petroleum. Right. So what happened? What happened then is that Massa Petroleum was trying to acquire Unico, right? But Unico board of directors, they tried to implement a anti-takeover defense. Right? They try to use I mean, we'll talk about anti-takeover defense in topic 3, but the idea is that they try to thwart the unwanted offer from Massa Petroleum, right? But then Massa Petroleum that didn't like the anti-takeover defense because they think that the anti-takeover defense will hurt the benefits of Massa Petroleum, right? So that's what they sued Unico board of directors, right? And then the Delaware court, after getting this case, they were concerned that directors may act in their own interest by adopting the takeover strategy, right? Well, because the idea is that directors, I mean, if you think about the board of directors of the target company, they have their self-interest by resisting the takeover offer. The reason is that if the company is taken over, board of directors are also have to find a new job, right? This will be bad for their future career. That's why they also have self-interest in resisting the takeover offer and getting the control benefits, right? So that's why the Delaware court was concerned that the directors resisted or used the anti-takeover strategy to benefit themselves, right? Because Delaware court, what they believe is that directors, they have the duty when there's a takeover offer, directors have to find and counter offer, have to make sure that not being taken over, so have to basically serve the best interest of the shareholder, right? Either, so if they want to kind of maximize the shareholder value when the takeover offer comes, either they have to prove that not getting the offer, not being taken over as the best for the shareholder, or conditional on being taken over, the acquirer has paid the best price ever. So this is what director duties are in the merger position. So that's why the Delaware court, after this case, they have established this Unico standard of director responsibility. Right? For example, this standard has two components. One is called reasonableness test. Right? So for example, in this test, inadequate price is considered a danger to corporate policy. So in that case, directors, they cannot accept an offer that has the inadequate prices to the company, right? And also, the director has this proportionality test. That is, directors only can take anti-takeover measures that is proportional to the threat that they are faced with, right? So when a bidder submits on an offer, directors cannot use the anti-takeover strategy to just make the offer impossible, make the cost of acquiring the company very, very huge, right? Whenever a company makes an offer, the directors of the target company, they need to use a reasonable anti-takeover strategy, right? To basically facilitate the price negotiation between the target and the bidder. So that's the idea. And when it comes to anti-takeover measures, we will talk about these kind of things in detail. Finally, another part of the directed duty in merger acquisition is called Revlon duties. So this set of standards also came out of the case, right? This is the case or the merger between Revlon Incorporation versus McAndrews and the Forbes Holdings, right? So in that case, Revlon Incorporation, they have adopted certain anti-takeover defenses that favor one bidder over another. And that this takeover defense actually hindered the auction process, right? Because we all know that the auction process in the merger acquisition is good for target shareholder, right? Because it makes sure that bidder pays the highest price, right? The final acquirer is the guy that pays the highest price, which is good for target shareholder, right? So again, again, the court believed that Revlon have taken takeover defensive strategy that is not good for the target shareholder, right? So that's why they have this Revlon duty have established, right? So these duties, they come into play when it is clear that a sale of the company is inevitable, right? So when the sale of the company is inevitable, it's Revlon duty make sure that the directors have the responsibility to maximize the gains for their shareholder, right? For example, a acquirer makes an offer to the target. The target shareholders, if they have the responsibility to look for the best offer ever to the target shareholder, right? So this is what the Revlon duty is about. So now back to the merger negotiation, right? So again, like we said, the director have the responsibility to make sure that target shareholders gets the best, right? So when I say get the best, that means when the takeover is not inevitable, directors can take anti-takeover strategy. But when the takeover is good for the shareholder, when the takeover is inevitable, directors have to make sure that the target shareholder gets the highest price ever. Right? That's the idea. Now, the process of merger negotiation, it could be quick or not. Right? For example, AT&T's acquisition of TCI, it's a friendly deal, it's a quick deal, right? But the acquirer overpaid, right? So basically, the AT&T did not do a very good due diligence process, right? The deal was so fast, the negotiation went so fast. That's why AT&T overpaid. Well, I mean, if you think about it, right? So it's always about the price. If you want to facilitate the price, you can always pay a high price, right? Money talks. So that's why a quick process is not necessarily good because, I mean, you might be paying too much, right? And during the merger negotiation, friendly negotiation might break down, leading to a termination or hostile takeover. All right, so what is hostile takeover? Hostile takeover is a takeover when the target receives an unsolicited bid. Right? So they don't the target management, the target company doesn't want to be bought, but an offer is made. Right? So this is hostile takeover. And this is the case between Moore Corporation and Wallace Computer Services, right? You can you can search this case and see how the friendly negotiation break down in the case of these two companies. And in other cases, the target might just say no to the bid right away, right? So in that case, transaction becomes a hostile one. One example is that the hostile takeover between Oracle and PeopleSoft. We will talk about this classic example of hostile takeover in later chapters, but the hostility in this transaction was unprecedented, right? Because there were multiple lawsuits involved during the merger negotiation process of the deal, right? So that's why you can see this really is a very hostile deal. So in the merger negotiation, another important clause is called material adverse change clauses. Material adverse change clauses, right? So these clauses allow either party to withdraw from the deal if a major change in the circumstances arises, right? And these adverse circumstances will actually affect the value of the deal. Right? For example, in 2017, Verizon and Yahoo, they both agreed to reduce the price paid to Yahoo's internet businesses by 350 million, right? And this brings down the total price to 4.48 billion, right? And then this is because Yahoo, after the transaction was announced, they have like exposed the data breaches, right? And this data breaches lower or adversely affect the value of Yahoo company, right? That's why we need this material adverse change clauses, right? And these clauses will also protect both parties if negative changes happen. For example, stock market crash. And also, for example, coronavirus crisis, right? these adverse and also unpredictable situations happen, right, which might decrease the value of the deal, right? When these kind of things happen, this clauses protect both parties. Right? And merger negotiation, the process of merger negotiation also are a little bit different when the deal is conducted using the auction process versus when a deal is conducted using the one-to-one negotiation. So this paper by Boom O'Hara in 2007, basically they have defined what is the auction deal and what is the negotiation. Right? So basically what they argue is that when the number of bidders that sign a confidentiality agreement is bigger than one, this is the auction deal, right? So a negotiation deal is basically just simply there's only one guy that signed a confidentiality agreement, right? And what they find is that more than half of the auction are involved auctions, right? So this is the idea. But they also find like 45% of the deals that they are conducted using one-to-one negotiation, right? So the reason why not all deals are made through auction, right? A big reason there is the agency cost. So simply speaking, right? Simply speaking, so what is the best way to acquire a company without having to pay a lot of prices, having to pay lots of very, very high prices? The best way to do it is that you tell the target management, we're gonna retain you after the target is taken over, and gonna pay you a lump sum, a very handsome amount of compensation, which we usually call the golden parachute payments. We're gonna pay you a lot after the merger, right? So that you should be willing to accept our offer, right? So this is almost like bribing the target management in order to get a deal through, right? So if this is the case, then we should see many one-to-one negotiation, right? Because for the acquirer, they actually do not want to involve one-to-one negotiation, right? Because, they actually do not want to go through the auction process because they have to pay higher. They have to pay higher if it's in the auction process. Right? So that's why one of the reasons why we see many one-to-one negotiation, part of the reason is because agency cost. Right? Another reason why there are also one-to-one negotiation is because if the target company has lots of proprietary information that they do not want to disclose to the public or to the competitors, right? So in that case, they want to avoid the auction process, right? Because in the auction process, many bidders will participate, right? And then you have to disclose those proprietary information, right? Sometimes including the technology developments, right, to the potential bidders. And many of these potential bidders might be your competitor, right? So if you want to avoid that, you also want to avoid auction, right? That's why so that's why in that case you want to do a one-to-one negotiation, right? And this paper by Bohm O'Hara basically finds that there's no difference in terms of shareholder wealth effect, right? The reason is the cost of benefit cancel out, right? I mean, auction has the benefit of boosting the takeover premium. It also has the cost of higher information cost, which is disclosing proprietary information to the competitors, right? One-to-one negotiation, they can mitigate information costs, but they also involve agency costs, right? So that's why they don't find the difference in the shareholder wealth effect. Okay, so let's take a break and we can continue on.